and the presentations is about the financial crisis and its consequences of the crisis. You can ask your friends from last semesters. Oh no, sorry, for last semester we won't have we didn't have the presentation, but I think FN251 term one 2019 or something. We at that time we had the presentations. Okay, it will be about the financial crisis and the consequences of the financial crisis. I will assign the topic to each group, and I will give you the details of the presentation later on. So now I would like you guys to know that we're gonna have the presentations, and the presentation typically it would be on our last class. Okay, on our last class, and in this semester I think it should be 15 in September. 15 September, because we're gonna have the class, the makeup class, right, on Sunday, 15 September, Sunday. So we're gonna have the presentations on that day. Okay, we're gonna have the presentations on that day, and you can see for this one we have 20%, right? 20%. So your final exam is gonna be 30%. Okay, 30%. Your final exams, because in this semesters we conduct the class in a normal situation. Okay, we will have the exams in universities. So your final exams gonna be both multiple choice and written exams. Okay, multiple choice and written exams. Okay, so you should prepare for that one. Again, 5% for quiz, 10% for presentations, and 30% for your final exam. Your final exam gonna be both multiple choice and written exam. Okay. So this is the score distribution. This is the score distribution in my part. With regard to the quiz, both quizzes are online. And the aim of the quiz is to help you prepare for your final exam, so you can work with your friend. But when you submit the answer, you should submit it individually. Okay, submit it individually. So I think some of you guys, when I finish talking about the score distribution, there might be some students ask me about the quiz, whether it's conducted in class, like a pop-up quiz, or online. I have to answer all of these questions, so I would like to make it clear in this class 2. In fact, this class 2 is like the first class of us, because last time I know that it is a last week before your midterm exam, so I will not spend much time on this score distribution. Okay. Okay. The quiz will be conducted online in TU Moodle. Okay, in TU Moodle. So I will upload the online quiz, and then I will give you the deadline of the quiz. And after that, you will have to manage yourself to finish the quiz before the deadline. Okay, before the deadline. You cannot do anything after the deadline, because the system will automatically close. I think you guys should be clear about the score distribution now. Do you have any questions, please, about the score distribution? Because this one will directly affect your life. So I would like to make it clear before I start my class properly. Do you have any questions on the score distribution? Okay, I assume that no one has questions on this one. Okay, thank you very much. Now let's move on to our slides. You will see that we have now three topics of the lecture. You can go directly into TU Moodle and you can download all the class slides from this one. And for the next class, if we finish all of these topics today, suppose that we finish all of them today, I will upload the slide one day before the class. So I will upload the slides on Fridays at maybe 9 o'clock in the morning. So you can go and can download the slide before coming to the class. And I will let you know about the information, about this information in your Facebook group, okay, in your Facebook group. I think you guys know that we have Facebook group, right? So let's check with your friend if you don't know about this group. Okay, now I will continue my talk from last week. I think we were somewhere here. Let me see. For this one, grading policies, because this one is a this slide took from the last semester, so you should discard this grading policy. Just follow what I just talked about the score distribution. So this one you should discard it. Okay. I think last time we talked about the adverse selection, right? I'm not sure about this. Okay, I think we are somewhere here. Now, I just talk about the adverse selection first. I will use this one to talk about the adverse selection. I cannot remember. You should ask your friend. It should be FN251 with the capital letter. I think FN251. Okay, I think it doesn't work. Visualize, so should be somewhere. Okay, now. Okay, I will start my talk with the adverse selection first. This is to recap what I tried to deliver to you last time, okay? Okay, adverse selection. I will give you the big idea of the consequences of the adverse selections on the financial system, okay, on the financial systems. Suppose that last time we talked about the market for the users car, right? You remember about this one? Market for users car, or the lemons market, right? Lemons market. Lemons here mean low quality goods, okay? Low quality goods, such as the second-hand car, okay? Such as the second-hand car. Now let's see. Suppose that you guys here in the class are buyers, or you guys are buyers. And you would like to buy a car, but that car is just a user's car, okay? You go to the market for user's car. And in the market, there are a lot of cars. This is my car, okay? One circle represents one car. One circle represents one car. Okay, these are cars. At this point, can you distinguish between good cars and bad cars? At the point when you step into the market for the first time, can you, without any information, without any research, can you distinguish which ones is good cars or which one is bad cars? Normally, typically, we cannot distinguish which one are good, which ones are bad, right? I am a seller of a car, okay? I'm a seller of these cars. So I should be a person who know or who have more information than you about the car, right? I know which one is good, which one is bad. And for this one, when you go to the market, can you tell me which price will you pay for the car? Or what is your willingness to pay for this car? The price that you would like to pay for the car when you step into this market. Okay, I will give you more information about this. The lowest price of the car here should be, let's say, this is just a hypothetical example. Let's say this one, 100 baht. Okay, 100 baht. And this one is 1,000 baht. For the examples, I just use very simple numbers, right? Which price will you pay, or which price will you be willing to pay for these cars? If you know that they are the bad and good car mixed together in this market, what should be the price that you pay for the car, that you're willing to pay for your car? It should be the expected price, right? The expected price. If you study mathematics, when we talk about the expected, it should be the average price of all these cars, right? So buyers will have the willing, they are willing to pay for only for the average price. Of the car in the market, okay? The average price. So the price here should be somewhere here, okay? The average price. It should be located in the middle of the price range, okay? It should be located in the middle of the price range from 100 to 1,000. 100 is the lowest price of the car in this market. 1,000 is the highest price of the car in this market. So the average price should be located somewhere here, okay, in the middle between the lowest and between the highest price. I assume further that some of these cars are lemons. Okay, let's put this black in here. Some of these cars are lemon. And some of these cars are peach or plums. I would like to say plum. Okay. Plums represents high quality goods. So plums here mean high quality car, which are mixed with the lemons, okay, for this one and this one, I just assume in order to give you the example of what I try to say. Now let's see what happens. Suppose that you guys are owners of plums. You guys are owners of plums. You know that the buyer will be willing to pay only the average price, which is surely lower than the intrinsic value of your car. Okay, you know the intrinsic value of your car, but because of your cars are very high quality, unfortunately they are just somewhere here with low quality cars. So the price or the intrinsic values, or financially speaking, I think I should use fair price. The fair price of your high quality cars should be higher, okay, than the average price that the buyers would like to pay for. Can you predict the results of this? I think last time some of your friends just told us already about the effects of this situation, or the final result, the final outcome of this situation. What will happen next if you were the owners of the high quality car in this market? Will you stay put your car in this market? No, right? So some of you may withdraw. I use the word withdraw. Some of you may withdraw your product out of this market. You will take your cars out of this market. Owner one just take this car one here out of the market. What happened to the price? The average price. What is the effects on the average price when someone just take the high quality good out of this market? The average price should move somewhere here, right? The average price should go down. You can imagine this when your midterm scores announced, right? Some people with the highest score will try to pull the mean up, and if they just withdraw from the subject, the means will go down. Okay, the mean score will go down. It is exactly the same here with this situation. The owner to just take these cars out of the market. What will happen next? The price will go down. As long as the price goes down, owner three here, this guy here, will also would like to take the car out of this market, because as you can see for this one, this is a distance. This is a distance from the fair price and the average price that the buyer will need to pay for, right? So this mechanisms will continue so far and so forth until the market left with only the lemons, okay? So that is why when the adverse selection presents in the system, the adverse selection will drive high quality goods out of the market, and only the low quality goods will be left in the market. We call this the market failure. We call this the market failure. Okay. And to be more specific, we call this situation debt spiral. Debt spiral. When the average price drive high quality goods out of the market, and in the market will be left only the low quality goods. The market functions very poorly when adverse selection presents in the system, or when the adverse selection presents in the market. Okay, this is the effects, unfavorable effects of the adverse selection to the markets. The markets will function very poorly in this situation because of adverse selection. When we have the adverse selection present in the market, it is likely to be this situation will be likely to occur. We call this the debt spiral, when the average price drive high quality good out of the market. Okay, So this is the consequence of the adverse selection in the market for used car. And this is what Arthur law. If you remember last time I talked about Arthur law, right? This is what Arthur law found when he analyzed the mechanisms of the market for the second-hand car or the market for the used car. Okay, debt spiral. Now, can you link this situation to the situation in financial market? Because this one, I'm talking about the market for used car, right? The market for used car, right? So, because we study FN251, it is something about the financial market. So, could you please help me link this situation to what will happen in the financial market? Okay, let's take the stock market as the example. Can anyone give me the explanation of the debt spiral? Or can you link the debt spiral to the market for stocks or the stock market? What will happen to the stock market if the adverse selection present in that market? We assume that the adverse selection present in that market. What is the consequence? It's gonna be the debt spiral too, right? It's gonna be the debt spiral. But can you give me the explanation or the mechanisms? I think I should call some of you to give me the explanation. Any volunteer here to explain the effect of the adverse selections? Anyone? Please help me. No worry, there is no right or wrong. Okay. Can you explain or can you link the spiral to the stock market? What will happen with the stock market? Any volunteer, please? I should ask for a name list. Okay, let me find some name list here. Okay, you can talk, you can consult with your friends and try to give the explanation. And then I will just ask some of you to link this one to the stock market. Okay, I will search your name list first. Okay.
Is it about the credit rating of the securities? Like plums represents like high credit ratings, and they ones represent like low credit ratings.
Thank you very much. That should be correct. Thank you for your answers. But for this one, when we talk about the credit rating, right? Normally, when we talk about the credit rating, we are talking about the market for bond or corporate bonds. But for this one, I would like you to apply this logic to the market for stocks. Please, you can give me another attempt. No worry, please. Imagine that you sit here and you talk for 3 hours. It is not a good experience because you just talk lonely and alone, right? So can you give me, thank you for your question, very good. Can you apply to the stock market? Because your friend answers a market for corporate bond. When we talk about the corporate bond, we mean the market for debt securities, right? The market for debt securities. But for this one, I would like you guys to link to the market for equity. Market for equity. Any volunteer, please. Okay. Let me find your name list first. I would like to have some information. Okay, maybe next time I will just ask you, because this one is just really easy and it should be your final exam, right? I may ask you guys to link this one to the stock market. Wow, okay, I see this. Pyramid, who is pyramid? Pyramid Kasem Gomez. Okay, pyramid. Can you link this spiral to the market for equity? I'm sorry. Please no worry because this one, even though I record the clip, but when I upload to the YouTube, I will make it unlist. Okay. So when I just call your names, please no worry. It will be not on the YouTube, public YouTube. So don't be shy. Just talk to me. When the YouTube unlist, other people cannot access to the link if they don't have link. Clear with please. Go ahead. And what's next? The final outcome. The final outcome of this. Correct. Yes, thank you very much. It is very easy. As you can see for this one, you just replace cars, right, to stocks. If the adverse selection present in the market without any tools or techniques to solve, the adverse selection. If the adverse selection present in the market, you will see that the market will function very poorly, right? And the market and the mechanism here, the average price, will drive high quality companies out of the market. Why? Because the owner of the company should know the intrinsic value or the fair price of his or her stock, right? If you are the owners of the company, surely you know. But other people, such as buyers, don't know the insider information. They don't have the insider information about your company. They are like these buyers here in the market for used car. So the buyers or the investors are willing to pay only the average price. And when you would like to raise the funds from the equity market, if you were the owners of the high quality companies, you will obtain only the price, or you will obtain the funds which somehow should be lower than the fair price that you should get, right? So the owners of the high quality company will not make the market, so the owners of the high quality companies will not sell their shares to the public, because they know that, okay, if the adverse selection presents, they will not obtain the fair price. When they don't obtain the fair price, the fund that they try to raise should be lower than it should be, As a result of this, the owners of the low quality companies, they are willing to offer their shares to the public. Why? Because they know that their fair price should be lower than the average price, right? That is why, if we have the adverse selections in our system without any tools and techniques to solve this adverse selection, you will find only the low quality companies or the company with high default risk in the market. I will try to link to the market for corporate bond. But the market for corporate bond and the market for equity are separate market. Okay, they are separate. So you will see that the market will function very poorly, and there are only the low quality stocks in the market, right? Because the fair price of the low quality stocks is lower than the average price. If you offer the stocks to the public, you will somehow obtain the margin here. Let's see this one. This is what you will get if you are owners of the stocks of the low quality companies. Okay, this is what you will get. But this one, if you are the owners of the high quality company, this is what you will lose. You will lose from the offer the stock to the public. your loss. It's going to be your loss. It's going to be the gain. For the low quality, it's going to be the loss for the high qualities. Okay, this is what the adverse selection predict the qualities of the stocks in the market. Any questions on this one, please? It seems to me that no one has a question. Okay, I will move to our slides, but let me find where should I start. Let me find the slide first. Okay, I will start from this slide. Okay, everyone, could you please go to your PowerPoint? It's gonna be this slide. Okay, tools to solve the adverse selection. From the market for lemons or the lemons market, you know that when the adverse selection present in the market, it will cause the death spiral. It will cause the death spiral in the market, right? So the market will left only the low quality goods or low quality companies or low quality securities. As a result of this, we will have to solve the adverse selection. And how can we solve the adverse selection? We can achieve this by out of these tools and techniques. The first technique that we use to solve the adverse selection is what we call the private production and sales of information. What is it? Let's see in a few minutes. The second one is the government regulation. Okay, the government regulation. For this one, the government here, it should be the security and commissions. Securities and SEC. SEC. Okay, let me show you this. In the context of Thailand, SEC is our regulator. Oops, okay, this one. Securities and Exchange Commissions, SECs. Also, in other countries, we also have SEC as a regulator. Okay, as a regulator, and these guys will implement some regulation. Will implement some regulations to the market in order to make the market function more efficient. Okay, in order to make the market function more efficient. Okay, now let's take a tour to okay. The next one is the financial intermediation. In fact, in my part, I would like to emphasize the roles of the financial intermediation, such as the commercial banks. We will mainly talk about the commercial banks because it is something that you can imagine and it's something that you get involved almost on a daily basis when you try to withdraw the money and use the money for your daily purposes. And the last one is the collaterals and net worth. What is collateral? Last time I just asked some of your friends. What is collateral? Collateral is like a security, right? Security is that when the borrowers go default, the lender can take the collateral, right? Can take the collateral. Can you give me some examples of the company in Thailand that run the business based on the collateral and net worth? Or the business that just make the profit from the collateral and net worth? They may just take the loan and they just resell the loan and they obtain some margin. Can you give me some names of that company? I just heard some from your friend. Can you tell me again, please? Can you give me some names of the companies that earn their livings by selling or buying loans, collateral net worth of the company. Can you give me some names of the companies that work on this one? In the stock exchange of Thailand, there should be 2 companies, I think. The first one, I think this one is what your friend try to answer me, but when I ask, I don't know, I may hear something that is not from your friend. BAM. Have you ever heard about this? BAM. What is BAM? I don't know what it stands for, but it is just the Bangkok Commercial Asset Management. You can see the stock price now goes down in the negative zone. Bangkok Commercial Asset Management, BAM. BAM. These companies make the profit from reselling the loans. They just buy the loan from the commercial banks and resell the loan. Sometimes they don't resell the loan, but they just resell the collateral. Resell the collateral, and they obtain some values. You can see that the economics, the Thai economies at the moment is somehow not good, right? We have poor economic activities during the time, and I think in quarter four, in Q4, we're gonna have a lot of default loan on non-performing loan, and the non-performing loan of the commercial banks. The non-performing loans of the commercial banks are the products of the BAM, of the Bangkok Commercial Asset Management, because they just buy the non-performing loan and then they resell the performing loan. Sometimes they resell the collateral of that loan in the market. This one is I think it should be the very big company that work on this one. And another one is I think JMT. JMT Network Services. This one also makes a profit from reselling the non-performing loan. But for JMT, the business that JMT get involved is the loan that we call it the unsecured debt. What is the unsecured debt? Any volunteer answer this question? What is the unsecured debt? This should be the very basic vocabulary for finance. What is the unsecured debt? And what is the difference between the unsecured debt and secured debt?
The debt that it can go default, like people
Thank you very much. Very good. Thank you. The difference between the secured debt and unsecured debt is the collateral. The credit card debt is like it. The credit card debt is an example of the unsecured debt. And JMTs run the business based on the unsecured debt. The debt from retails. Unlike the business of the BAM. Typically they work with the debt with the collateral. So they work with the debt that we call the secured debt. As a result of it, the market capitalizations, the values of the stock, the value of the market, the value of the company multiplied by the stocks. The BAM should be very big cap company. However, during this time, because our economy is not good, you can see that the stock price of the BAM goes down, but the JMT goes up. So can you give me another examples of the company that work on this debt? The last one, the small one, is listed in the market for alternative investment. The smallest company that work on this one, what is it? It seems to me that you guys knows a lot of finance. The last one is Chayo. Chayo is a stock or a company that also run the business based on selling, reselling, sell loan. Okay, but this one is a very small capitalization, the small companies. If you would be very, if you feel interested in this business, you can start by researching all of these companies because they located in different market. For BAM and for JMT, they are listed, both are listed in the stock exchange of Thailand. But for Chayo, it is listed in the market for alternative investment or MAI. It's trying to capture the market share, but their customers would be different. Okay, different types of customers. So you should, if you would like to study more about this one, you should start by looking at the balance sheet of these three companies. Okay, now let's get back to our textbook lecture. Okay, collateral and net worth. Collateral and net worth. Do you have any questions? Please. Thank you. Collateral and net worth are also the tools that we use to solve the adverse selection. And how can we use these techniques to solve the adverse selection? Let's start by private production and sales of information first. This one I just took from the textbook, so it would be very boring. But I think anyway you should know this one as your starting point or as a basis before you study further on the finance. And this topic is very important, the topic of the asymmetric information, because when you study in some further courses, you should hear the topics about the contract theory, or the market mechanism design. Nowadays, if you would like to study maybe for your master degrees or for your PhD, I think one field that would be very interesting is the field that combine finance and law together. If you know finance, it shouldn't be enough nowadays. You should know law too. If you know both laws and finance, you can decide the market. For example, you can decide the market or the mechanisms that reduce the adverse selection. This is for the examples. Okay, let's get back to this one. The private production and the sales of information. This is the techniques that we use to overcome the adverse selection. Because the buyers and the sellers on the two sides of the transactions have different information about the transaction, right? One side of the transaction tends to know more about the transaction than the other side of the transaction. So there should be some companies that collect the information of the product, such as the user's card, such as the equity, the information of the equity, or the information of the user's card. And then they sell the information to the side that has little information compared to another side. I will take the examples of the market for user's card. The buyers of the user's cards tend to have little information compared to the seller, right? So there should be some company that collect the information of user's card and sell the information to the buyers. For this one, it is exactly the same. This company, Standard & Poor's, Moody's, and Value Lines, are the companies that collect the information of the companies in the market and sells the information. It may be in the form of the credit rating. It may be in the form of the credit rating to the investors. Because the investors should be the side that have little information compared to the owners of the company, right? So, to reduce the degree of the adverse selection, selling this information should reduce the adverse selection, right? So we will have the business that make the profit from selling and buying the information. Suppose that you are the institutional investors, and you subscribe to the services of these companies. That is, you buy the information from this company, because this company just research the information and sort the information and then just sell the information in terms of the credit rating. When you as the investors buy this information, you can use this information to invest in the market wisely, right? The Ministry of Finance or the institutional investors should subscribe to these services, and then they can use this information to lay out the investment plan. What will happen if they just buy the information and they just implement this information to the investment plan? What will happen next? This is the result of this one. I don't know how to type it in English because I'm not sure whether the information will be in English or not, but I will type in Thai. Let's see. Okay, try this one. Stop that the Ministry of Finance invest by okay, it should be somewhere that look like this. Okay, I cannot find it in English, so would you mind if I type it in Thai? Okay, thank you. Okay, this one. This is the problem with these measures, because you can search on the internet and you now know that the Ministry of Finance invests in these stocks. As the retail investors, how can you use this information? You just invest like the Ministry of Finance, right? You can replicate by buying these stocks without paying anything to the Moody's, to the Standard & Poor, right? If you engage in this transaction, you're gonna be the free rider, okay? You're gonna be the free rider. You enjoy the benefit without paying anything. And this benefit is investment strategies. So you can replicate the investment strategies of the Ministry of Finance. This is the problems of these techniques, because the private productions from this company and selling this information to the maybe institutional investors or the Ministry of Finance or the government, there might be the free rider that can replicate or can make use of the information without paying anything to this company, okay, without paying anything to this company. So this is a problem, the free rider, okay, the free riders. Now let's think in a very small scale, okay, in a very small scale. Suppose that you guys are the investor that subscribe to the services of this company. Will you subscribe to these companies or not? If you know that there are free riders out there, and you can Google the stock that the Ministry of Finance invests in the market, will you subscribe to this company? No, right? No, because you know that you can find the information with zero cost of harvesting. So the economic activity here should not be occur, right? Shouldn't be occurs because we have the free riders in the system. So this is the first problem with the first method, private production and sales of information. We're going to have the free rider. Even though this technique can reduce the decrease of the adverse selection. Now what next? The government regulation. Now we turn to the Securities and Exchange Commission, or SEC. The government agencies can enforce the regulations to the firms in the market and let the firms disclose the information to the public. This is what the government agencies can do at the base. Okay, at the base, this is what they can do. This is what they can do. Now, what is the problem? What is the problem, or what is the issues here for the government regulation? Imagine that you are the owners of the low quality companies, just for the examples. Will you disclose the honest information to the public? Will you disclose the honest, or will you be very transparent to the public? No, right? So the problem with these techniques is that the firms or the low quality firms tend to disclose the information that not benefit to the public much. They may not be honest, and they may just disclose only good information without any bad information. So you will learn very little for this information disclosure. Okay, you will learn very little for the information disclosure for this one. This is the problem with the government regulation that try to enforce to increase the information. Even though it can reduce the decrease of the adverse selection, it still has some issues. Okay, this one you just go to the moment. Okay, this one is I think this one is the most efficient tools that we use to overcome the adverse selection, which is the financial intermediaries or financial intimidation. Now, can you tell me why this is the most efficient one? There is only one word for this one. Why this one is the most efficient way to overcome the adverse selection? Okay.
Because the banks are also the third party who also inflate the firms at some for their associated benefits.
Okay, thank you very much. Thank you very much. In some ways, it's correct. It's partly correct. And give me another attempt, or any volunteers to share the idea with me, please. Why the financial intimidation or financial intermediaries is the most efficient way to overcome the adverse selections, when others techniques such as the private production and sale of information or the government regulations cannot be achieved like the financial intimidation. Thank you for your answer. Any volunteers for this one, please? Why financial intimidation is the most efficient way? Do you have any idea for this one? What is the difference between the financial intimidation from the government? What is the difference?
Financial intimidation, like give up loan and then they receive interest. But for government, they just give up money from the taxpayer, and it's not that efficient.
And how about and what is the difference between the financial intimidations and the company that collect the information and resell the information to the market? They also earn the profit from selling the company, please. Thank you very much. That's partly correct. Of course, the financial intermediaries, we have more incentive, right? to engage in the transaction such as collecting the information from the loan because they make profit from loan, right? Because they earn the interest rate, right? Your friend told me, and they have to repay the interest rate to the depositors, right? If they don't hire the experts into the business, so is it likely that the structure of the banks is very fragile? It can bank run, okay? It can be the situation that we call bank run because we have the long-term asset but the short-term liabilities for the banks. It's partly correct. So can you give me the answer that correct? That fully correct for this one? Financial intermediation. Thank you for your answer. Thank you very much. It makes my day. Okay. Okay. Can anyone share with me your opinion for this one? It is only one word, and is it a keyword for this one? That makes the financial intermediation different from other tools.
Is it predictability?
Partly correct. Thank you very much. Thank you very much. What is the difference between this one? Okay. Okay, thank you. As you can see for the financial intermediation, you can read it from the slide, but I will talk. Financial intermediation, when they engage in this kind of the business, when they give a loan, when they make loan to the firms, they have to research very carefully in order to squeeze the information that reflects the quality of the firms, right? One thing that makes the financial intermediation different from the government, different from the credit rating agency companies is that the information here is private. Banks will not sell this information to other parties. That is, the loan here is not traded in the market. The loan that bank makes, that loan isn't traded in the market. Is not traded in the market. So the information of the bank is very private. Banks is the only one who know the qualities of the loan, and they don't share this information to other parties in the public. As you can see for this one, in order to solve the adverse selection is to collect the information and use the information privately and don't share the information to the public. Why? If you share the information to the public, or the public can see the pattern of your investment, it's gonna be the free rider in the system, right? So when we have the free rider in the system, as you know from the market failure, the economic activities will not occur. And for this one, because banks collect the information and they themselves use the information and don't share the information to any other people in the market. So this one can overcome the adverse selection. So the keyword is that non-traded loan. Non-traded loan. The loan from the banks will not be traded in the market. So the information is not public. Okay? The information is not public. Okay? Now, this will lead to fact number 3. This will lead to fact number 3 and fact number 4 from the highlight facts. Yes, highlight facts that we studied from the very first class. This is a reason why indirect finance is very important than the direct finance. Okay, because it can overcome the adverse selection. Non-traded loan. Non-traded loan. Okay. Do you have any questions, please? Do you have any questions? Okay, thank you. Now let's move on to the next slide, or the next techniques that we use to overcome the adverse selection. Okay, for this one you can read from the slide, but what I told you is summarized from the slide, so you can read it. Last time I think I talked about the pecking order hypothesis already, right? So I will skip the pecking order hypothesis. Okay, the last one, the last method, or the last measure that we use to solve the adverse selection, collateral. And okay, it should be collateral and net worth here. Collateral and net worth. Why collaterals and net worth can overcome the adverse selections? If you remember, the adverse selections is the source of asymmetric information that occur before the transaction takes place, right? This is occurred before the transaction, before we engage in the transaction. And how collateral and net worth help reduce the degrees of the adverse selection. If you guys are the lenders, can you tell me why collateral and net worth can make you feel more easy to make loan? How? Please talk to me. I am human, okay? So we can talk together. How? How can the values of the collateral and net worth reduce the degrees of the adverse selection? In the eyes of the lenders, you guys now are lenders, okay? You guys now are lenders. So in your eyes, why collateral, the value of collateral and net worth can make you feel, okay, easy, very easy to make loan. Why? You will be more confident, right? You will be more confident if you make loan to the companies or you make loan to the borrower with high collateral. By high here, I mean high value, okay? High values of collateral and high value net worth. Because when borrowers go default, you can take collateral or you can take the net worth rather than collecting the debt, right? So the higher values of collateral and the higher value of the net worth will somehow help to reduce the degrees of the adverse selection. And remember that adverse selection takes place or occurs before the transaction. So when you think about the collateral and net worth, you should think in terms of the lenders to the borrowers. Okay? Okay, later you can read from the slide. I think there is nothing to me. Okay, the next one. This is also a tool that we use to solve another source of the moral hazard. Another source of the asymmetric information. Please allow me to see my slide because for this one, I think I should start from our next slide. Okay, let's skip this slide and go to this one. Right now, TU model, not banking management. Let me see this one. Okay, let's go to this slide, the next slide, this one. In fact, it is a slide that continue from the last class, but this gonna be our first slide, okay, from the second set of the lectures. Now, let's talk about another source of the asymmetric information, which is moral hazard. Okay, what is moral hazard? Moral hazard is a source of the asymmetric information that occur after the transaction. This is the key difference between the adverse selections and moral hazard. Adverse selections occur before. Moral hazard occurs after the transaction. When you have already engaged in the transaction, or when you have already made loan to the borrower. Okay. So the moral hazard. When we talk about moral hazard, like we are talking in the adverse selection, we will have the example. The adverse selection, we use the market for lemons as the example to explain the ideas of the adverse selections on the structures of the financial system. For moral hazards, we also use the examples. And for this one, we will talk about the equity contract. Okay, equity contract. When we talk about the equity contract, we are talking about the structures of the firms. Okay, especially the administrative part. In the firms, we have the stockholders, okay, or the equity holders. Equity holders of the firms are the owners of the company, okay, are the owner of the companies. And we also have the managers, okay, the managers. The managers is a person who managers are persons who are in charge of the lots of kinds of the business, like CEO. I think we can say this is like CEO, okay, who are in charge of the business, who are in charge of the activities that try to increase the sales or reduce the cost. But the owner just supply only the funds to the company. You can think like this one, okay. And in these examples, the principals here should be the stockholders or the manager, the principals. The principal here should be the stockholders, okay, the stockholder. The agent here is the managers. If you cannot imagine the managers and the stockholder, you can imagine like landlord and farmer. The landlord is a person who obtain the agricultural products from farmers, okay? And farmers is the persons who just harvest and just assert the effort. And in exchange for maybe the house, in exchange for the land, but the landlord is the owner of the land and gather the products, the agricultural products, okay? So in that situation, the principals there is the landlord, okay, is the landlord, and the agent is the farmer, okay, agent is the farmer. In classroom, who is the principal? A lecturer should be the principal, right? Agent should be student. Why? Because as you can see, the principals or the lecturers may be a person who would like students to exert the effort, okay, exert the high effort in study. However, the agent or students, I don't assume you guys are students in my example, right? I just use a hypothetical example to give it the definition of moral hazard. But normally, those students in my example, our students may have the tendency to be very lazy, right? They may not want to wake up in the mornings and come to the class. They may not want to finish their homeworks because they would like to use their time to maybe to use the leisure and to go shopping or gaming or something, right? As you can see for this one, the objective of the principals as a lecturers and the objective of students are something that is conflict. We have the conflict between the objective of the principals and the objective of the agent. The agent tend to do something in their own interest, which is different from the objectives of the principals. So we call this problem the principal's agent problem. The problem about conflict. The problem about conflict between the principal and agent. Okay. Okay, now let's turn to these finance examples. Equity contract. What is equity contract? Equity contract is the claims on profit and asset, right? It's the claims on profit and asset. No matter what the companies have the profit or not, it is a claim on that one. And who are in charge of the value of the equity? Principals or agent? Principals or agent, sorry. Stockholder or managers? stockholder or CEO, who are in charge of keeping the values of the equity? Manager, correct. Managers, or the CEO, right? CEO is a person who is in charge of the everything in the company. So one thing that is the main duties of the CEO or the agent is that they have to try to maintain or keep the values of the equity. And who are the person who benefit from the value of the equity? CEO or stockholder. Stockholder, right? Stockholders are the person who benefit from the values of the equity. If the price of the equity goes up, the net worth or the assets of the stockholders will also go up too. In this case that I'm talking, the managers in my examples don't own any shares, okay? Don't own any shares. They have to exert the effort, run the companies, make the companies profit, and they have to maintain the values of the stock. The stockholder just fund the company or just give the money to the company. And stockholder can go traveling in every country and let the manager work with the business. This is what we call principal and agent. Will CEO exert the high effort in this business? Suppose that you don't have any benefit from the stock. Will you exert the high effort? While you receive the fixed salary payment, let's say 100,000 or something per month, will you exert high effort in this company? Normally, no. Because the managers or the CEO receive the fixed payment from the company, right? But the results of their administrations will affect the values of the stock. But the value of the stock, who benefit from the value of the stocks is the stockholder, not the CEO. So this is the problem. We have the conflict here between the stockholders and the CEO. The CEO wouldn't exert the high effort because they obtain the fixed payment. They can use the money, go traveling. They may buy a private jet, or they may buy some paintings with very high values. And after that, when they were kicked off, when they are kicked off from the company, they will also receive a big amount of money too. You can see this case from Disney. Okay, it's really a classic case, business case. I think Disney. Disney. Okay, Disney you can see this example from that one. Sorry. Okay, this one. So this is the principal and agent's problem, the conflict between the principal and agent. Agents will act on its own interest, which is different from the objective of the principal. This is what we define the principal-agent's problem. Okay, for the equity contract, as the example that I try to give it to you, you will see that if you take a closer look of this example, you will find that we have the separate ownership, right? The ownership, the separate ownership separation. The owners of the companies is the stockholders. While manager just exert the effort, just work like farmers, and the stockholder just like the landlord, right? For this one, you can see that if we have the equity contract, we tend to have the principal and agent's problem arises in the sequence. Okay, the keyword here is conflict and the separation of ownership and control. Okay, ownership and controls. Okay, I want to ask you, between the principal and agent, who's gonna have more information than the other side? Managers or the owner? Managers are the person who have more information about the transaction or about the company than the stockholders. Okay, for this one, I will link to other examples. Okay, maybe it is a real world examples. If you would like to invest in the stocks in the stock market, you will see that before you invest your money by buying and selling the stock in the market, you need to do some homework. You need to research the information. You need to keep your eyes on the balance sheet of the company. Why? As the stockholder, you don't know much about the company, right? You will see this one, I think, very clearly. Why managers or the person, when we have the board meeting, that person or the manager or the CEO know very much about the company. Why the stockholders are the person who just ask the question. The CEO is the person who answer the question. Okay? So this is separation between the ownership and control. What time now? Okay. Oops. Okay, I think I will go to this one. Okay. For this one, I'm gonna talk about the tools and techniques that we use to solve the moral hazard in this setting. Okay, we try to solve the moral hazard in this one. And you can see that the equity contracts is not the efficient way that we deal with the moral hazard. Oh, one thing that I forgot to tell you. You can think of the situation that the managers own some fraction in the stocks. Okay, the owners or the stockholders own the equity, right? But there might be some situation that the owners or the stockholder owns the stock, and the managers, they also own the stock too, but some fraction of the stock. For that one, the manager will somehow care about the profit of the company, but the fraction may not be large. It may be very little fraction, so it somehow still have some incentive to do something that is on their own interest, which is contradicting to the objective of the stockholders. Okay, now let's say for this one, we will use the tools and techniques like the adverse selection to solve the problem in the moral hazard. The first one is the production of information. In adverse selections, we will have the companies that collect the information and sell the information to the general public, right? Such as the institutional investors. But for this one, we also have the process called monitoring. The process of monitoring is to monitor the behavior of the managers. The stockholders may hire someone to monitor the behavior of the managers. Now let's think about it in this way. Suppose that I am a manager of the class, and BBA programs is the stockholder. BBA can monitor my behavior through what? Through that one, that gadget, that gizmo, that camera just record my behavior in classroom, right? You can think of some example like some high school, or now I think you heard lot of news right nowadays about the school, and you can see that the camera just record the behavior of teachers. So that camera here in our class is like a process of the monitoring here, because now when the BBA hire me as a lecturer, this is the situation of the moral hazard. BBA would like me to exert high effort in teaching, right? Now I'm a manager, but BBA is a person who gain maybe the benefit from my teachings. I think this one can be the example. So the process called monitoring arises in the scene. In the context of the financial market, when you collect things or when you produce the information by monitoring, you may have to hire someone to monitor the behavior of the managers. in the form of auditing. So that's why the accountant is very important in the job market, because the accountant is a person who partly monitor the behavior or the outcome of the manager's efforts. If the managers assert the high efforts without any uncertainties, the company should be in very high profit. Okay, so the things or the auditors or the accountants can collect the information there, like a monitoring or like a camera here in our rooms, and then they just report this one to the stockholder. However, the process of monitoring is very costly. It's very costly in terms of time and money. Economists call this quarterly state verification. When we talk about verification, we mean that we can use the evidence in the court. Okay, we can use the evidence in the court, such as the recording from the camera. You can use the recording in the camera as the evidence in the court. So this is very costly. On the quarterly state verification is the issues that arise in these techniques, and this will somehow produce what we call free rider again. Free rider. Can you give me some explanation why free rider arise in this situation, please? Any volunteer, please? I feel very tired now. Why? Sorry. Can you give me, or can you tell me why free rider arise in this context? Okay, I will just go. Miss Mana, sorry, Mana Apinawatha Wankun, Mana, right? Which Mana? Oh, hello. I think you listen to music, right? Okay, can you explain how free rider arise into the context? How free rider arise in this context? Your friend can you can help her. Okay, you cannot help her. How free rider arise in this context? In this context, when we use the monitoring, how free rider arise in this context? Mana, okay, I'm sorry, Mana, for the first time. Mana, okay. No one can help you. What goes around comes around. Okay, how can free riders arise in this scene? Any volunteer to help Mana? How can free riders arise in this scene? No worry, please just give me your opinion. I would like to hear from you because I feel very tired. I talked for 1 hour and a half now. Okay. How can free riders arise in this context, Mana? Otherwise, you have to sing your song that you listen for. You can help your friend. Okay, I give you, I think 1 minute now. Ready? Okay, thank you, Mana. Okay, I will let you listen to your music. I will ask other people. I know that you may listen to the lecture recording, not music. Nithit, Mr. Nithit Hong Sharon. Nithit, would you mind if I skip you because you just give me your answer already? Or would you like to answer? Please, okay, let me give you.
I'm not sure.
You can tell me. No worry, please.
Like, I think the problem is about if the auditor has a conflict of interest with the managers. Like, well, I not really know how to explain, but.
Okay. Thank you very much. Okay, thanks a lot. You can see for this one, the free rider can arise into the scene because if one stockholder hire a person to monitor the behavior of the managers. Other stockholders can use their money to go traveling to other countries, or to use the money to can enjoy the benefit from the money without paying or without hiring anyone to monitor, because we have our members, one members of the stockholder just hired already, right? So other members of the stockholder just enjoy the benefit without paying anything. So in this case, other stockholders are free riders. As a result of this, if you were a members in the stockholder, will you pay the money to hire a person to monitor the behavior of the managers? Why your friends just enjoy the benefit from your action? Will you pay for it? No, right? No. This is the problem of the free rider. When free riders arise into the scene, no one will pay for the service. No one will pay for the person, and will hire the person to monitor the behaviors of the managers. Okay? So free riders arise into the scene. Remember that when we have the production of information, if that information is not private, there will be other people that enjoy the benefit from that information. Okay? So that is the free riders. Thank you. Please.
But if the stock price goes down, all of the stockholders will be responsible for that. And I think other stockholders that become a free rider will lose this benefit as well. So I don't think the free rider will kind of happen.
Thank you very much. If the stock goes down, what will happen? All stockholders will force the managers to work hard. You can think of the stock price as the signal. You can think of the stock price as the signals that reflect the effort of the managers. However, in some certain circumstances, such as during the recession, even the manager exert the high effort in the business, the final outcome will not be good because of other external factors. Okay, so stock price can be used as a signal whether the manager exert the high effort or not. But in that regard, all stockholders will force the manager to work hard. So we can use it as a signal. In this case, the free riders arise because one member of the stockholder hire people to monitor the behavior of the managers, while other people or your friends just enjoy the benefit from your action. So no one will pay for this one. This should be the final consequence of the whole process. Thank you very much. What is your name again, please? Nitit. Okay, very good, Nitit. I will tell PR. Very good. Okay, you know PR, right? Okay, PR is the lecturers of lecturers again. Okay, now let's move to the government regulation. This is another tool that we use to solve the moral hazard. Okay, for this one, I will not argue. I will explain it. The government in this tools, the governments also try to enforce the firms to disclose the information and try to implement lots of regulation with the firms. So this is the reason why the financial system is the system that is very heavily regulated. I think this is from fact number 5, okay? Because we have the government try to implement lots of regulation to implement the behavior of the firms. That is why the financial system is the most or is very heavily regulated. This is the structures. That is the result of the moral hazard. When we have the moral hazard, the government try to enforce the laws, try to enforce the regulations to direct the behavior of the firms. So that's why financial system is the most heavily or is so heavily regulated system in the world. Sorry, I need to drink something. You can see that the government can enforce the law. However, will the firms behave like what the government wants? They may try to behave in a way that the government wants, but somehow we don't benefit much from this regulation. We here, I mean investors, will not benefit much from this regulation. Okay, now let's continue. I will add some explanation for this one. You can see that even though we have a lot of regulations, we also have the loopholes in the regulation. So firms can use the loopholes to do some things in their own interest. So that's why this one, the government regulation can somehow reduce the degrees of moral hazard, but it cannot eliminate the moral hazard from the system. Okay. Would you like to take a break? No. Okay, very good. Okay. The next one, financial intermediaries. I will talk on financial intermediaries and the and covenant. Okay, and then I will let you have a break, and then we will move on to the next topic, which is the banking. Okay, this one. Let's see. Financial intermediaries. You can read from the slide, but I will talk. Financial intermediaries or the third parties can be used as a tool to solve the moral hazard. A very classic examples in the textbook, they will take the examples of the venture capital firms. The venture capital firms is the financial intermediary that supply the fund to the small scale company or the small medium enterprise. However, because of the moral hazard, venture capitals send not only the money but also send their people into the board. Send the people into the board of that small medium enterprise. This is another process. This is also a process of monitoring. But when you have a board meetings, the information in the meeting will be private, in private. So the information that the venture capital collecting from the meeting is not shared in public. It's not shared to the public. So that is why financial intermediaries here is a very perfect way to overcome the moral hazard. Okay? It is like our financial intermediaries or financial intermediations can be used to solve the asymmetric information. And it is the reason that is why we have the financial intermediaries in the real world. Because of asymmetric information. It can solve the asymmetric information. And when the financial intermediaries solve the adverse selection and solve the moral hazard, it will help the market function very efficiently. That is, the market can channel the funds from the surplus unit to the deficit unit with the investment opportunities or with the productive investment idea. It will channel the fund to the right person. Okay, it will channel the fund to the right person. Without the financial intermediaries, the funds will channel to the wrong person, and market will not function well. Okay, this is about the financial intermediaries. Now let's move on to the last one. The last one here is the covenant. We call it restrictive covenants. Restrictive covenants. What is covenants? can you give me the definition of this? Please, you can use Google and you can translate. What is covenants? Covenants. What is covenants? What is restrictive covenant? This one, the last one. The last techniques that we will use to solve the moral hazard. What is the definitions of the restrictive covenant? It should be, if you search the definitions of the restrictive covenants, it should turn to the definition like the agreement, okay, agreement, or the contract, agreement or a contract, okay, agreement or a contract. This contract or this agreement is written with the objectives like this one. The restrictive covenants will discourage undesirable behavior, encourage desirable behavior. These are pretty straightforward, okay? Do something that the principle want, don't do something that contradicts to the objective of the principles. Keep collateral in values, provide information. This contract or this covenants is what we use to direct or to guide the behavior of the managers. Okay, it's like a contract. That is why if you study advanced or intermediate microeconomics, we're gonna have the topics about the contract theory. The contract theory. How can we write the contract that will produce the efficient outcome from the market. Okay, you need to decide the objective of the managers, and you need to decide, technically speaking, we have to decide the utility functions of the managers, and that function or that utility function should be somehow aligned with the objectives of the owner or the stockholders. Okay, so the restrictive covenant is what we use in these situations, and the desirable outcome. The desirable outcomes of the restrictive covenants is what we call the incentive compatibility. Incentive compatibility. That is, the objective of the managers align with the objective of the owner. That is the incentive compatibility, which is the outcome of the restrictive covenant. Okay, and this is the reason why that contracts are extremely complicated, because you have to write, you have to take into account lots of factors that affect the behavior of the managers. This is the summarization. You can wait for this one. Okay, now I will let you go for a break, and then I will go for a break, and then we will return to the lectures. We will start the topics of the bankings. Okay. Okay. See you in 5 minutes or 10 minutes. 5 minutes or 10 minute break. 5 minute break or 10 minute break. Would you like which one? 10 minute breaks. Okay.